Hello again and welcome, and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. Headquartered in Fort Worth, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for our presenter, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, a PDF of today's presentation is available for download now, should you wish to follow along or reference it afterwards. With that, I'd like to introduce our presenter today, who is Kamal Shah, who is a Managing Director of Indirect Tax at Source Advisors. Kamal has been in the tax industry since 2005 and has assisted many companies ranging from startups to Fortune 500 companies with complex tax matters. Over the past 15 years, Kamal has successfully identified and recovered more than $75 million in overpaid indirect taxes for his clients. And with that, I'll hand it to Kamal.
Thanks, Ann. Hi, everyone. As Ann mentioned, my name is Kamal Shah. I am a CPA by trade. And my area of expertise has been, for the last 20 years, sales and use tax. I'm based out of New Jersey, Jersey City, New Jersey. And for the last 20 years, I spent the first 5 years of my career at PwC. And then the last 15, I had my own practice, which was acquired by Source Advisors back in 2023. And what our practice of about 20 professionals focuses on is various state and local tax matters. Since the Wayfair ruling in 2018, about 70 to 80% of our workload has been around sales and use tax, because it impacts every business regardless of what they buy or sell, because sales tax is applicable in any sort of transaction that a company might be doing. So our involvement, it can be anything from compliance, voluntary disclosure agreements, nexus studies, refund reviews, which Ann touched upon. So as we go through the presentation, please feel free to ask me any questions or shoot them in the chat. If we can't get to them during the presentation, we'll get to them at a later date. This is the brief agenda that we're going to go through today over the next 45 to 50 minutes. First, I'm going to give you guys a quick history of the Wayfair decision. That was a 2018 Supreme Court ruling that significantly changed the way sales tax was applied. And the reason that was a big deal is because it actually reversed the decision that the Supreme Court had made back in 1992. And at that time, when they reversed their 1992 decision, that was the first time this Supreme Court was, going into the business of reversing old Supreme Court decisions. The next thing we're going to touch upon is essential sales and use tax concepts. Sales and use tax is a bit of an odd animal because it isn't really required to follow any kind of GAAP or IRS regulations. So it's a little complicated for some CPAs. So what I'm going to do is I'm going to touch upon 2 or 3 different concepts that if you can understand those concepts, then you'll be in a position to identify what sort of issues or questions your clients should be looking into and where there could be some exposure areas. Based on that, we'll touch upon the different CPA offerings that you can provide to your clients. Although it's referred to as sales and use tax, because it touches on so many different parts of the business, there's many different service offerings and many ways CPAs can help their clients. The fourth thing we're going to discuss is how overpayments happen. Most of the conversation when it comes to sales and use tax or any tax liability usually surrounds around making sure that businesses are accurately paying their liability, but overpayments do happen. And you want to make sure that if there are overpayments happening, how can you adjust that? Do you have to give an exemption certificate, or is there an issue with how the invoicing is being done? What changes you can make, because those will have a direct impact on the business owner's tax bottom line. And then the last thing we're going to touch upon is the updates that happened at the end of 2025. Although the Wayfair ruling happened in 2018, it's been 8 years at this point. States are still changing how they're going to do the nexus simplification. Are they going to try to make it simple? How do they want to structure nexus standards in their state? How are they going to adjust tariffs? Are tariffs going to be included, not included in the tax base that sales tax should be calculated? Those are some of the things that the states issued rulings on towards the end of 2025 and the early part of 2026, and we'll touch upon that at the end of the presentation. Okay, so let's start before the Wayfair ruling. What was the law of the land before 2018? The law of the land before 2018 was based on a 1992 ruling called the Quill ruling. And in 1992, the Supreme Court basically said that in order for a business to be required to charge sales and use tax on an invoice, that business needs to have a physical presence in the state, okay? And the physical presence that a business can have in a state could be done in a couple of different ways. They can either have an office in the state, right? Whether it be a headquarters, a warehouse, any kind of office would count. Or if they have employees. I live in New Jersey. A lot of New York-based businesses have maintenance contract trucks that come through New Jersey. They have employees that work every day in New Jersey on different sites or at different customers' houses. That's enough to have nexus. Or the third thing is inventory. If you're storing inventory in a state, that could count as physical presence. But what that does is that most businesses, if you're below 100 million, you're probably not going to have physical presence in more than a couple of states, which means that you're only required to collect sales and use tax in a couple of states, which by lowering the amount of businesses that are able to charge sales and use tax, states had a very low low taxpayer base that they could get revenue from. They tried to be aggressive. They tried to say, hey, click through Nexus cookies, through the websites or affiliate. If I'm a business owner and I have some affiliates that are doing sales or something for me in another state, they would try to say that that's Nexus. But because of the Supreme Court ruling in 92, the states didn't really have a lot of success in figuring out how to kind of pierce the 1992 ruling and say that they had Nexus. What really changed all this is in 2017, the state of California sent notices to Amazon and said, when you have all of these businesses that you're doing fulfillment for Amazon by, and you're holding on to their inventory in your location and you're handling everything for them, we think that counts as having Nexus. And because of the large volume of sales, we think that these companies should be registered and paying sales and use tax in California. Amazon, for reasons that no one really is aware of or sure of, they just voluntarily decided to comply. They started just collecting sales tax on these transactions, and overnight, the state of California was able to significantly increase their tax base. Other states, paid attention to this. There was a lot of federal inaction. The federal government was not willing to get involved and, ask states to say, can you guys try to get along and have some rules between one state and another where there's overlap, so it's a little bit easier for businesses to participate and enact sales and use tax rules, and that wasn't happening. And then the other thing worth mentioning is that there weren't that many technology tools available. Avalar and Vertex both operated as private companies. They're now huge providers of tech stack solutions, but back before the Wayfair ruling, because there weren't that many businesses that needed these solutions, they were small private companies. Now, what happened is that on June 21st, 2018, the ruling was released. Now, people like me that were in the industry at that point for 10, 15 years, we didn't expect the court to rule the way it did because the 1992 Quill ruling was between Quill and the state of North Dakota. What made this decision kind of weird is if you look at the five justices, it's Kennedy, Thomas, Ginsburg, Alito, and Gorsuch, not really five that typically rule together, but in this instance they did. And their basic premise was that now businesses are very different than they were back in 1992. Between social media, the internet, how businesses can operate through drop shipping, it's possible that a business can have significant presence in a state without ever having physical presence. And then the other thing they said is that, because of all the technology advancements, South Dakota is not placing an unreasonable burden on these retailers. This was an interesting kind of distinction that they made. Now, all the different states that were watching the Wayfair ruling, when the state of South Dakota's Department of Taxation and Finance issued the assessment on Wayfair, they knew that Wayfair was going to dispute it. They knew that it was going to make its way through the courts because the 1992 ruling was there. While the Supreme Court was taking, several months to kind of look through the fact pattern, every state in the country was paying attention to what was happening, and a lot of the countries were getting their rules and books in order to be able to implement their own rules. But they wanted to see what kind of guidance the Supreme Court was going to get. The Supreme Court said the only two things that they wanted to note when they made their ruling was that it's not going to be retroactive. States like Massachusetts and Hawaii had tried to, go past the Quill ruling in the past, and they said the past rulings stand. It's going to be effective 2018 forward, and that yes, it would be unfair for small businesses. So they created a nexus standard of $100,000 a year in sales or 200 transactions in a given year in a specific state. If you have less sales than that, then you're deemed to be a small business and you don't have to worry about sales and use tax. Because all the states were watching this, by the end of 2019, most states in the country had a rule in place, and Florida and Missouri were the last two holdouts, but they finally passed rules by 2023. Sales and use tax is in 45 of the 50 states. The 5 states that don't have sales tax, the acronym to remember it is NOMAD. It's New Hampshire, Oregon, Montana, Alaska, and Delaware. However, Alaska now, Anchorage, and some of the larger cities do have their own city-level sales tax. So this is what the result was. This is information that we got directly from the state's websites. And what we did is we looked at the revenue, because sales and use tax revenues have to be published. We looked at 5-year intervals in 4 states to see what was the consequence of the Wayfair decision, right? You look at 2012 to 2017, the increase, Texas, North Carolina, South Dakota had an increase in revenue, but that was primarily driven by population increase and inflationary increases. But then when you look at the difference between 2017 and 2022, you see South Dakota, they were able to double their revenue, which was huge for them, right? Even North Carolina, a 50% increase in their revenue. And some people don't realize, but in the states that have sales and use tax, the revenue amounts that the state raised from sales and use tax makes up anywhere from 25% to 35% of the state's annual operating budget. So this was a huge boon to the states. And that's why, while the Supreme Court gave each of the states the permission to have economic nexus rules, it wasn't a requirement, and all 45 states chose to take that up to expand their tax base. Let's stop right there, grab a sip of coffee while Ann goes through question 1. Oh, there it is. What was the small business exemption that the Supreme Court applied to its decision?
Just a reminder, you do need to respond to 3 or 4 polling questions, and this is our first. And they are starting to roll in. And it looks like the majority so far says C, $100,000 in sales or 200 transactions.
That is the correct answer. So the answer is C. I'm going to touch upon it a little bit later at the end of the presentation when I go through the nexus simplification. That whole $100,000 or 200 transactions, that started to confuse taxpayers, right? Because if you have a client that has an annual contract, but you send them 12 invoices, or they make 12 payments without even an invoice, but you send them a reminder or a progress update or status update, but you're sending it to them every month, does that count as 1 or 12? So what's happened is, of the 45 states, I believe 31 at this point have dropped that transaction count and have purely based it on the dollar sales amount. Lack of uniformity in economic nexus rules. So because the Supreme Court only gave a little bit of guidance, the states have all kind of decided their own rules on everything else, right? So dollar amount, we were just talking about that $100,000. The Supreme Court put the minimum at $100,000. So 40 of the 45 states stuck to $100,000. California, Texas, and New York decided to keep it at $500,000 because they were larger states and they didn't want to deal with the smaller volume returns. And Mississippi and Alabama put their number at 250,000. Then what do you include in that sale? What if you're a company that sells half your sales are to not-for-profits? Or what if you're a manufacturer or a wholesaler and all you're doing is selling sale for resale? Should that be included in your $100,000 amount? And again, even on that, every state has a different rule. So some states look at the gross sales. What does that mean? That means that if you're a wholesaler and all you're doing is selling 100% of your goods or sale for resale, if you're operating in a state where the state says that it's based on your gross sales, then you're still required to file a zero due return. So you'd file a return that would say, I had 100,000 in sales, all 100,000 were sale for resale or exempt from sales, and you owe nothing, but you're still required to collect that. Should you include your marketplace sales? Most small businesses now are using Amazon or Etsy or some kind of marketplace seller to include to expand their client base. And they might have a website, but a large portion of their sales might come through Amazon. In some states, what they want you to do is, even though Amazon is handling all your sales and use tax responsibilities, and maybe even 95% of your sales are happening on Amazon, they want you to add your Amazon sales number to your website sales number and then see if that number is over that $100,000 amount. And if it is, then you're supposed to be collecting sales tax on your sales that are taking place on your website. And then the last point there is, when does Nexus begin? Some states have said, New York says that it starts, they try to say it would be the very next transaction. From an administrative perspective, that's hard to do because sales and use tax registration requires its own form. Just because you register for business doesn't mean you automatically register for sales and use tax. You have to fill out its own form. You have to submit it, and it could take anywhere from a week to 30 days to get it. How do you do that? If you don't know when you're going to hit that amount. And then some states have gone the opposite end, like New Mexico, for example. No matter when in the year you hit your economic nexus numbers, you have to register following January 1st. So if you hit economic nexus in March, you have to wait all the way until the following January to register. Really no lack of consistency. They don't really make it easy for businesses that have operations in 3, 4, 5 states to make compliance very easy. And what ended up happening is you have now businesses as small as $10 million a year in sales that have to register and file in 30 states. And that becomes very challenging because not only are all the things that I mentioned, varying from state to state, we'll touch upon a little bit later, the taxability rules also vary from state to state. Something like software. I live in New Jersey. The way software is taxed in New York is software delivered electronically is taxable. In New Jersey, software is taxable unless it's delivered electronically and purchased for business use. So any of your clients, depending on if they're having the software being billed to New Jersey or New York, the taxability is going to vary. That really makes it complicated to be compliant in all of these different states, which is why you have tools like Avalara, Vertex, TaxJar coming out there, SarahTax, to make it a little bit simpler. And then the last bit we touch upon is every state now has a marketplace facilitator law, and that's a good thing. What that's referring to is that states are requiring companies like Amazon and other marketplace facilitator to be responsible for collecting the sales and use tax and filing the returns, because that makes it easy for the business, because now they don't have to worry about it because it might be a smaller business. And then it also makes it easier for the states because they can process less returns. Attempts for uniformity in sales and use tax have ceased for all practical reasons. As I mentioned before, the Wayfair ruling, the federal government was trying to encourage states to have commonality between them. The SSTA refers to the Streamlined Sales Taxing Authority. That was a group of states that was coming together and saying, you know what, we'll compromise with each other and we'll have all of our rules be comparable, so it makes it easier for businesses to follow. But that was going to be done so it would be easier for businesses to give the businesses the kind of the carrot to be compliant in sales and use tax. But now the Supreme Court has given them the stick, so they don't really need to make it any easier. And you can see that in the way they're operating. The SSTA, it exists, but it hasn't added or changed much in the last 5 to 7 years. There's no federal bills being created to create uniform filing standards. And then the last bit over there is the local sales tax application. In some states like Colorado, Illinois, Louisiana, Arizona, the towns and the municipalities don't necessarily have to follow the state's taxation rules. And a lot of these localities with limited resources were taking some time to kind of come up with how they wanted to adopt the Wayfair ruling. But now, as we move further and further away from the Wayfair ruling, more and more jurisdictions have come out with where they stand on this issue. The following was a result of the South Dakota versus Wayfair ruling.
This is our second of 4 polling questions. And they are just starting to roll in, and they're sort of equally divided. But so far, the majority says A, states significantly increase sales tax revenues.
Yeah, that's a bit of a trick question. The answer there is actually, it's an accept question, which tends to be a little trickier. The following was a result of the South Dakota versus Wayfair ruling. The answer there is actually B, but I'll go through all the other options, right? So the first one is states significantly increase their sales tax revenue. That's true. I showed that slide that showed that in the state of South Dakota, they doubled their revenue. Other states like North Carolina, every state that's done it has significantly increased their revenue. The states that had, the less populated states that tend not to have large businesses located within them or large physical presence, they saw a larger increase in revenue, but that was pretty much across the board. Why the answer is B is because I mentioned all the different areas where a unified sales tax collection process is not the case, right? There's 100,000, 250,000, 500,000. That's one type of difference. The other difference is sales, retail sales, taxable sales. Those are 2 big differences. Then again, with the registration, when does the registration start? Is it the next transaction? Is it a month later? Is it a year later, or 8 months later? And then some states look at the calendar year. Some states base it on a fiscal year. So there's really no sort of unified collection process. There is the small business sales tax collection requirements did increase. Although there's a small business exemption, I would argue that having a business that's $2 or $3 million is relatively small business. But we have clients that have $2 or $3 million a year in revenue and have to be filed in 4 or 5 states. And then every state has adopted an economic nexus status. That one tends to trick people up because yes, not all 50 states have adopted an economic nexus status, but 45 of the 50 states have, and the 45 that have are all the ones that have a sales tax. So the only ones that have not are the ones that couldn't adopt it because they don't have a sales tax. So a bit tricky, but the answer there was B. Okay. Before I jump into that, was kind of the end of the Wayfair part of it. The next thing we're going to talk about essential sales and use tax concepts. Before I jump into that, there is one area that I wanted to talk about that I touched upon, which is that sales and use tax, it requires its own registration. So if you're registered to doing a business and you're headquartered in that state, you do have to register for it. The reason you have to register for it separately is because sales and use tax is one of only 2 taxes in the country, the other one being a payroll tax, that's referred to as a trustee tax. And what a trustee tax is where the business is saying, hey, client or customer, I'm collecting tax from you, but I'm collecting it on behalf of the taxing authority. I'm not going to keep this 6, 7, 8, 9%, whatever the tax rate is. I'm going to collect it and I'm going to remit it to the taxing authority. And because the state is kind of giving you the ability and the right to do that, they take that very seriously. And how they take that seriously is when you register your business for sales and use tax in a specific state, you have to list what's referred to as a responsible person. Now, this responsible person is either going to be a business owner or an officer. And what makes that person responsible and what makes it a really big deal is when you say that someone is a responsible person, if that business becomes bankrupt or if it's sold or if, let's say, they just, they close down and disappear, and if there is a sales and use tax liability outstanding, that person who's listed as the responsible person is going to be held responsible, and you can't expunge that liability by saying the business went bankrupt or anything else like that. You're going to be held personally liable. So that's a very important concept as it relates to sales and use tax, and it's unique to sales and use tax. It doesn't apply to IRS. It doesn't apply to state income tax or any kind of state gross receipts, property tax, or anything else like that. So before we jump into these other concepts, I wanted to mention that. The essential sales and use tax concept. Tangible personal property, TPP, versus services. The way the law was written, because use tax rules are, started in the 50s, 60s, 70s, and 80s, back when the U.S. economy was primarily based on selling goods and was based on selling goods. The U.S. becoming a more service-based economy is, 5, 10, 15 years old. Prior to that, the economy was based on selling goods. So the way most states drafted their laws is, unless there's an exemption, unless there's an exemption and it's not a sale for resale, the sale of goods and services, the sale of goods are going to be subject to tax. So most goods, laptops, pens, papers, anything that can be touched, felt, picked up with your hands is subject to tax in every state unless there's an exemption that has sales tax. The opposite is true for services. Most services like CPA services, medical services, professional services related to IT, consulting, most services are not subject to tax. And if the services are going to be subject to tax, they're usually services like repair and maintenance services that don't necessarily add value and just keep TPP or real property functioning in the way that it was already functioning. But even with that, services and real, as I mentioned over there, services to TPP, they're not even taxed everywhere. They're only taxed in about 2/3 of the state. And that's repair services. Like, so your car breaks down, you need to get it repaired. That's going to be likely subject to tax. And even less states tax services to real property. So the classic example is, the HVAC maintenance contract or cleaning services. Those are the type of services that are going to be taxed. This is starting to change. Business and professional services that weren't typically subject to tax are now slowly starting to become taxable. And even when those services are taxable, they're going to be either taxable in a reduced rate, like the state of Connecticut. Their normal sales tax rate is 6.25%, but services are taxable at 1%. In the same way, if a service is taxable, it's a very targeted service. So like Pennsylvania targets headhunting and recruiting services, but that's because they're slowly and doing a targeted taxation of the services. Now, if you understand what's taxable and non-taxable, the next thing to figure out is what are the sourcing rules, right? With the U.S. Having 50 states and interstate commerce being so easy, you could have a transaction where the business is located in one state. They're getting something either built or delivered in a second state. Their client or their vendor, is located in a third state, and maybe there's a delivery truck that's in a fourth state that's going to be doing the delivery. In that instance, how do you figure out what state's sales tax rules should dictate the taxation of the transaction? And the way the law is written is that you have to look at where the benefit of that sale was derived. Where was the ultimate destination for the benefit to be derived? And the thinking from the sales and use tax is where that good or service is delivered is where the benefit is derived. So if I get something delivered to my house, then it's taxed at my house because they're going to assume that it's used in my house. If somebody from New York drives into New Jersey and buys something because New Jersey has a lower sales tax rate and drives it back to New York, it's going to get taxed into New Jersey because the vendor had no way of knowing where it was going to be used. They have to assume, based on the information they have available, that it's going to be used where they're delivering it or where they're providing it. And services works the same way, right? Your office, there's something wrong with the HVAC, or you have a cleaning service. The benefit is derived in that office location, so it's going to be taxed at that location and based on that location's rate. Okay. Those two rules are normally how things are structured unless there's an exemption. So there's two types of exemptions. There's a statutory exemption, which is that's just the way the law was written, right? So a good example is real property. When you buy a house or if you're renting a house, the way the law is written in every state is that the rental of real property is not subject to tax. Now, there's a couple of states like Pennsylvania has an exception for it. Florida used to have the rental of commercial property used to be subject to tax, but they've changed that rule. It's already sunsetted out. But that exemption is written within the law in every state that real property is not subject to tax. Same thing like services, CPA services, medical services, or food. It's referring to grocery food. Like you buying an apple, it's not subject to tax. If you go to a restaurant, that's different. That's looked at as prepared food, not this food that I'm referring to here. And then there's also non-statutory exemptions. What a non-statutory exemption is saying is, hey, this thing is normally taxable, but me as the business owner am going to use it in a way that the law says that it's exempt from tax. So the two easiest examples of that are resale. Lenovo makes a laptop and then they sell it to a wholesaler. That wholesaler sells it to another wholesaler, sells it to another wholesaler, who sells it to Best Buy, and then I went to go buy it in Best Buy. In that transaction, all of the different wholesalers, as well as Best Buy, they kept issuing a sale for resale, and the only person that had to pay sales tax on my purchase of my laptop was me, because I had no sale for resale exemption certificate to give because I'm using it for my own purposes. Another exemption that's readily available is the manufacturing exemption. So if I buy a piece of machinery or the raw materials or even the utilities like the electricity or the gas that's needed by a piece of manufacturing equipment to produce something, that's all exempt because businesses want manufacturing to take place in their state because it creates so much economic value for their state. So they give that exemption for that. They give an exemption for that. And then the third one I mentioned there is not-for-profit exempt use. Most government agencies or a 501c3 entity are going to be not-for-profits, and in most states, not-for-profits are not subject to tax. Now, because people started kind of creating, not-for-profits for non-charitable purposes or purposes that states didn't agree with, some states have guidances that says that now it has to be a not-for-profit that's either a government agency, does something related to healthcare or education. But again, those agencies have a certificate. They get when they get billed an invoice for anything, they can give that their vendor that certificate. The vendor will remove the tax. And the great thing about being the vendor in that instance is it's not the business of the vendor to police who provides them with exemption certificate. They just have to take the certificate and hold it for their records. Obviously, they have to take it within reason and know that it's honest, like it is the company name that you're billing the invoice to. The EIN does look like a real EIN. But as long as you do those couple of basic things, if you get audited, if the vendor gets audited and the state's like, wait a minute, this certificate was invalid, you're not going to get in trouble for it because you're not in the business to police them. You give them the certificate, and then it's the state's responsibility to go back to the vendor and say, wait a minute, why did you provide the certificate? It's invalid. And now you're creating a liability issue. This is, the source model. I think Anne touched upon it earlier in the presentation. The source model is how do different CPA firms handle sales and use tax. And in our experience, what we've found is that about a quarter of the firms fully insource the work, which means they have a couple of people in-house, a manager, partner, whoever it is, a few people in-house that handle all the sales and use tax work. And they'll sometimes reach out to us when they have an area that they want to just double check on or something that's outside of their wheelhouse. Then about a third of the companies we work with, they do some of the work in-house. And what that usually entails is the CPA firm is based out of, let's say, the Northeast. They'll do the tax work in the Northeast because they've dealt with it so many times. But if it's in California or Georgia or some state that they're not that familiar with, they'll look for somebody else to do that. Or maybe they're in an industry. Maybe it's a company that works with SaaS companies, and 90% of their businesses, their clients are in the SaaS space. So no matter what state it is, they'll do the SaaS work. They'll do work related to SaaS businesses because they understand those rules. but outside of that, they're not sure of how to handle it. And then the 40% of the CPAs that we interact with, they have no interest in doing anything sales and use tax related, so they outsource it to other firms. But even for those companies, it's important to understand, what are the different things that you can do for your clients. So that's what the next slide is going to go over. It's talking about what are the different services that we can offer. And we have it laid out in this kind of, chronology because you have a lot of small businesses, 2, 3, 5, 10, $15 million businesses that they've heard about Nexus, they've heard about this, but they don't really know, how they have to go about becoming compliant. It's a huge, it's a huge issue. They understand it's an issue they need to address, but they don't know how to address it. So this is kind of the way the process would start. The company would come up to you and say, hey, we have, a few $1 million in sales, but we don't know what our exposure is. So the first thing you do is a nexus study. So you figure out where they have physical nexus and where they have economic nexus, and then how many years does that go back? Because the rules started to come about in 2019, but it took some states as late as 2023. Now, if you have a business that's been around for 5 to 10 years, do they have exposure going back 5 years, or do they have exposure going back 2 years because they lucked out and their exposure is in a state that was slow in getting their rules out there? Once you determine, where they should have been filing, well, you can take a look at the liability. Where is the liability? How much liability do they have? And then the next step is figuring out, can they mitigate the liability? I touched upon like the whole exemption thing, right? If they're selling things that might have a manufacturing purpose, reach out to the customers and see, did you use this for a manufacturing reason? Can you give me an exemption certificate? Or maybe did you sell something to a not-for-profit? Whatever you can do to reduce that liability. Once you finalize that liability, every state now, because of the influx of businesses that need to be compliant, has something called a voluntary disclosure agreement program. The voluntary disclosure agreement is where the state says, we get it, the rules are complicated, you didn't get it, and now you have 5 years of exposure, 10 years of exposure, 2 years of exposure, whatever it is. Why don't you come forward and get registered? And to incentivize coming forward, the states have offered a few different things. So the first thing they're going to do is they're going to reduce the look back period. Let's say the business has presence in a state that started in 2019, and it happened to be a state that changed their sales and use tax rules in 2019. Now in 2026, you're talking about 7 years of exposure. So the first thing the state says is, you know what? We're going to reduce that period because you were honest and you came to us and we didn't find you. If they find you, they're going to go back as far back as they can. If you come under the voluntary disclosure agreement, they're going to reduce that look back period to either 3 or 4 years, depending on the state's statute of limitations. Most states in the country are 3 years, but then you have like Texas, New Jersey, and a few other states are 4 years. So they're going to reduce that look back period and just want to get the tax back for either 3 or 4 years. So that's the first thing they're going to do. The second incentive they're going to give you is they're going to do what they call abating of the penalties. Abating of the penalties means that, again, if they would catch you, they're going to charge you anywhere from 20 to 30% in a penalty. You owe 50,000, there's a 20% penalty, so now you owe 60,000. So they're going to abate that penalty again because you were honest and you came forward. And then the last thing that they used to do a lot more often, but they don't do anymore, is, and they barely do it, is they may give you a break on the interest. Again, that is kind of ending now, and the states are basically saying, you know what, the Wayfair ruling came out in 2019, now it's 2026. We don't understand why it took you 7 years. So while interest used to be forgiven, they're stopping to do that. So now you get the voluntary disclosure to handle the past liability. The next step, either through the VDA process, or maybe you don't need the VDA because there's not a big exposure amount, you have to do the sales and use tax registration. This is where I mentioned that it's its own form, and you have to figure out who's going to be the responsible person. Get the ownership group together, draw straws to figure out who wants to be the person that's going to get put on there, and come to a conclusion on that. Once you're registered and filing in the state, the next thing is figuring out what we refer to as a taxability matrix. If you have a company that's selling 3 goods, right? They're selling maybe piece of software, a piece of hardware, and some kind of service. 3 things. But they're selling in 7 states, or they have economic and physical nexus in 7 states because they have 10 million in revenue. Very feasible, right? But now you have 3 things in 7 states, 21 different items that are not going to be consistently taxed because the rules vary. How do you keep track of something like that? We tell clients that once they get over the $5 million mark, it is extremely difficult unless you have someone full-time dedicated to invoice processing to make sure that all your invoices are correctly billing out tax, unless you do some sort of technology tool, Avalara, Vertex, Seratax. And then the next thing that a CPA needs to help out with is implementing that technology tool. So you have that $7 million retailer, that SaaS company is going to start charging sales tax. Okay, they're going to buy Avalara. They're going to subscribe to the Avalara platform. Great. Now that Avalara platform, you just pay for the platform. You still have to make sure that the platform is properly connected and communicating with both your ERP system and or your point of sale system, because the invoice has to get taxed in real time. And that requires a tool. If that tool isn't doing everything correctly, then garbage in, garbage out. Your data that you're going to use to file your returns is not going to be correct. Which leads us to number 7, the ongoing compliance. Depending on how much sales tax you're paying, that is what's going to dictate how often the business is going to have to file sales and use tax return in that state. So if you're only paying a couple of $100 or $1,000 or $2,000 a year to the state because not a lot is taxable, or your sales amount aren't that great, they only want you to probably file on an annual basis. But if you're remitting $100,000 a year in sales tax, they want their money faster, and they're going to ask you to file monthly. So depending on how much tax you're paying, you're either a monthly, a quarterly, or an annual filer. And then once this is once they're set up and they're going, it's a reoccurring thing. They're going to be filing their returns, and everything kind of stays pretty static unless the taxpayer gets picked to have it picked for audit by a specific state. What drives the audit? We get asked this all the time. It really varies from state to state and from year to year. Sometimes it's as simple as states realize that, like in Pennsylvania right now, we have a lot of staffing firms that are getting audited because back in 2021 or 2022, the state started saying headhunting services, right? Where you reach out to a company, you say, hey, I need to hire an intern, or not an intern, a staff accountant. They're going to get paid $22 an hour. I'll pay you $28 an hour. All of those staffing firms were supposed to charge sales tax on that spread, the fee that they were charging. And when the state realized that because that service is not taxable, I think it's only taxable in like 3 or 4 states, so many companies were overlooking taxing it. A lot of staffing firms are getting taxed. Or if one of your vendors or one of your customers gets taxed and they flag your invoice, they're like, wait a minute, this is a SaaS company and they're not charging tax. This is a furniture company. Why wouldn't they charge tax on this invoice? They'll kind of mark your invoice and it'll go into a pool of companies that they're going to look to tax. And then the last thing we do for a lot of our clients is a reverse sales and use tax audit. And we'll do exactly what the state's doing, but the inverse. We'll look through a company's tax business and records to see if there's overpayments in taxes. This is
Okay, purchases by manufacturers that are exempt by most states include materials that become a part of the finished product, manufacturing equipment, utilities, or all the above. And so far, it appears that the majority says D, all the above.
Yeah, I know we're a little behind. I'm just going to can I answer the question and move on, man, or do I have to wait?
You can answer the question.
Yeah. So the answer there is D. It is D, all of the above. Everything that gets included in the manufacturing process is exempt. Those 3 items are exempt. So yeah, that was the right answer. Polling question number 3. Okay. Is there any good news? And yes, as it relates to tax, there is a little bit of good news. Because of the complexity related to sales and use tax And because of all these companies trying to become compliant and being worried about being compliant, there's a lot of errors being made where a lot of taxpayers, and you really can't blame them, right? If a business is the classic example is contractors, right? Contractors, they do some work that's subject to tax and they do some work that's not subject to tax. Like a capital improvement project where they help something get built out, or doing a new kitchen or something, that's not subject to tax, but repair or painting or something like that is subject to tax. So rather than worrying about every invoice being taxed correctly or not being taxed correctly, or spending $5, $10, $20,000 and getting a tech solution in place, some businesses are like, we're just going to charge tax on everything because half of it is subject to tax, so we're going to do it that way because I don't want the headache. And it sounds a little odd, but a lot of businesses are doing that. So what that creates is it creates a refund opportunity for the business if it's happening on their purchases side, or it creates a refund opportunity for their customers if the business is erroneously charging tax on their sales. Going back to that utilities exemption with the manufacturer, I recently had a company that was, all they do is they produce copper wiring that's used for different purposes. So they were well aware of the resale exemption certificate, and they were also well aware of the manufacturing exemption. So all of the raw materials they weren't paying tax on, all of their equipment they weren't paying tax on. Their factory build out, they knew that was a capital improvement. They weren't paying tax on that. But what they overlooked is the utilities. The electricity that they were using was exempt. The amount of electricity that they were purchasing close to $2 million a year in electricity. They were in a state where the tax rate was 8%. 8% times 2 million, 160,000, with a 3-year look back. So 480,000 is what they were able to get. When the good thing about refunds is that when you find the refund, you're allowed a few different options on how you go about getting the refund. So you can either get the refund from the vendor, you can get the refund or you can get the refund from the state taxing authority. The one thing that trips a lot of businesses up, we'll ask them about how things are going, and they'll say, "Oh, everything is going great. We just had an audit, and so we can't be making overpayments." No. I've done hundreds of audits in my career, and I can count on one hand the number of times an auditor has identified to me where a taxpayer was overpaying taxes. So we always advise clients that if you're going through an audit where the state is auditing you, it always makes sense to look for the overpayments, because the state is not obligated to tell you about it, one. Two, if the same information that the state's going to ask you to look for underpayments is the same information that we're going to look at to find overpayments. And three, any kind of errors that we find, not only are you going to get refunds on a historical basis, you're also going to be able to make those corrections in your business policies and procedures to minimize the overpayments on a go-forward basis. So I think we have an example here. Now, sales and use tax rules vary from state to state, but we picked this exam for two reasons. One reason is because this same law exists in these 5 or 6 states. It's New York, Illinois, Pennsylvania, Massachusetts, Washington, and Utah. And the other reason we picked this is because this was one of my clients that was an insurance brokerage house. Right? A lot of clients think that, hey, my client is a professional services company. They're an engineering firm. They're a law firm. They don't buy things. They don't sell things they don't buy software and computers. They don't do manufacturing, and they don't sell things that are subject to tax. So there's no opportunity. So here's the situation. The New York headquartered company has 400 employees, right? So what that's saying is companies located in New York, their headquarters are in New York. So, which means all of their invoices are getting billed to New York. Remember when I said early part of the presentation on the sourcing rules? When that company was being billed their invoices from Microsoft had no way of knowing where their 400 employees are located. They just know that everything is getting billed into New York, so they're going to tax everything in New York. New York's sales and use tax rate is 8.875. So this company was an insurance company, 400 employees. They had 2 offices. One office was in New York, and they had a satellite office in New Jersey. 250 employees in New York, 150 employees in New Jersey. And they were spending between Microsoft, their ERP systems, as well as the actuarial software systems, they were spending about $2 million a year in technology costs. And everything was being taxed in New York. But here's the math: $2 million a year in spend times 3 years of spend, because that's the statutory look back in New York. So now you have $6 million a year over that 3-year period. The sales and use tax that they're paying is 8.875. So they paid over 3 years about $500,000 in sales and use tax on their $6 million of IT purchases. But the way the law is written is that the software which was delivered to their employees on their software electronically, software delivered electronically used for business is taxable in New York, but it's exempt in New Jersey. Okay, so this client we were able to secure them a almost $200,000 refund for something that they buy, and then we were able to adjust their invoices on a go-forward basis. So every year, they had a cost reduction of roughly $70,000 to $80,000 on their technology costs. And then the last thing that I wanted to touch upon really quickly is kind of the updates that are taking place. The big one that maybe some of your clients have asked you about is tariffs. Because tariff is basically, I know there's some, I don't want to get into the politics of it, obviously, but there's an argument of, is that a tax or is that not a tax? And if it is a tax, it's a little weird that there would be sales tax on top of tariffs, because that's a tax on a tax. Tariffs are taxable even if they're separately stated in the invoice. The reason for that is because they're looked at as a part of the sales price, and anything that is taxable, all of the charges associated with selling that product are going to be taxable. Meaning you sell something for $100 to your customer. Now you're being very transparent to your customer that, hey, I have to charge you $20 because there's a 20% tariff on it, and the sales tax rate is 7%. You have to bill that customer $8.40 because it's 7% on the 120, not on the $100. And I think, early part of 2025, when tariffs were first being implemented, there wasn't a lot of guidance. We felt pretty strongly that it was going to be included, and now most states have released their notice that says, yes, it is subject to tax. The other thing that a lot of states are doing is they're modernizing the tax base. That's just a fancy way of saying they're changing their rules to tax things that people are buying. Digital goods, a lot of digital sales are happening, so more and more digital goods are being taxed. States are making it clear by changing their laws. Like Washington State just changed their rules in October to clearly say that things that weren't previously being taxed are now getting taxed. Digital goods. Maryland is now taxing a lot of digital goods that they weren't taxing. But the flip side is essentials are not getting taxed. At the same time that they want to expand their tax base, they want people to move into their states. So like personal hygiene items, grocery store items, those things are not getting taxed. And then the last thing the states are doing is what we refer to as nexus simplification. They're moving away from that transaction count, right, 100, 200, and then just purely basing it on that dollar amount that we touched about, 100,000, 250, or 500,000. When this was started back in 2018, 2019, only 13 states never had a transaction count, and now that's up to 27. That's a little dated. It's actually up to 30 now. So that was a big change, and I expect that by the time these Nexus rules are finalized, every state is going to drop their transaction count and purely base it on dollar amount. And that brings us to the last following question.
All right. When companies overpay sales tax, they can recover the overpayments in which ways? A, file refund claims with the state. B, obtain refunds from vendors. C, offset audit assessment with refunds. And D, all of the above. And Kamal, there are two questions that Carrie has posed. I can read them to you if you can.
You know what? Why don't I just go through this and then we'll do it at the end of the presentation, because I realize we're a little bit over the allotted threshold. So can I answer the question, or are we still waiting?
Yes, go ahead. Please.
Yeah, the answer there is D, all of the above. I'm not sure where everybody was coming in, but yeah, the answer is all of the above. You can go about them anyway. The only kind of I'm sorry, I'm just going to go back to that question really quick, because there is one small nuance. The question doesn't come back up. You are allowed to go to either the vendor or the state. The only exception to that is that it varies from state to state, like everything else. So, for example, in Georgia and Virginia, in those states, in some of those states, in that area, the way the law is written is that the person that overpaid on their taxes has to reach out to their vendor and say, hey, one, can you confirm that I overpaid on this tax? And two, confirm that you're not going to pay it to me. Once you do that, then you take that form and you take it to the state, and then they'll pay it out. Other states, Illinois, Texas, New York, New Jersey, Massachusetts, you can do it either way. You can go to the vendor can give it back to you, or you can go to the state, however you want to do it. There are a couple of states, the only ones that come to my mind right now are Arizona and California, where the states have said, you know what, we're not getting involved. You guys figure it out yourselves, and once the vendor gives the customer the tax back, they can adjust their records and we'll give the vendor the back, but we're not dealing with individual customers because that's just not something they want to get involved with. But other than that, yeah, I mean, you can handle it a few different ways when you do identify an overpayment. And that brings us to the end of our presentation. I'm going to stick around for a few minutes and answer any questions. But yeah, I appreciate everyone's time. Please feel free to shoot me an email if you have any questions.
There are several in the Q&A. Would you like me to read them, or?
Yeah, can you just read them? Yeah, I see them actually. Carrie,
Okay.
Can you repeat the discussion about the responsibility falls on the purchaser, not the vendor, when it comes to the resource? Yeah. So what that's saying is that if you're a business owner and you're selling, whatever goods and services you're selling, you have to charge sales and use tax unless you receive an exemption certificate. When you receive that exemption certificate, you don't have to police it, right? If you get an exemption certificate from a company and that company and the name makes sense and the exemption certificate is properly completed, like they put an EIN number that is the 9 or whatever digits the EIN number has to be. They didn't just put it in 101 Main Street. If it looks like it's a valid certificate, you just have to hold on to it for your personal records. When you get audited, you tell the state, we didn't charge this tax because they provide us with this exemption certificate. If the state tells you, then wait a minute, that business, that EIN is invalid, then they have to take it up with the company that provided you with the invalid exemption certificate because they provided you with a fraudulent document. You're not in the business to police them. I hope that made sense. I know it sounds a little bit a little odd that you're allowed to not get in trouble for something, but you just have to make the good faith effort. And if there's an issue with that, that's something between the company that provided the fraudulent document and the state taxing authority. Yes, I agree with you, Carrie. Sales tax software costs, they are prohibitive for smaller businesses. What I would say to that is that it's prohibitive to smaller businesses if they're selling a lot of different SKUs. If you're only selling, a couple of SKUs and selling a couple of different products, the guidance on that is readily available. The states are publishing more and more guidance, and it really becomes complicated if the goods and services that your client is selling are a little bit different or a little bit more nuanced. If they're selling something like SaaS, the rules on SaaS are available. You can Google them across the country at this point. And sales on most physical goods are pretty clear cut, but I do agree with you that if you're a small business that's at, let's say, $3 million a year in sales, but you have a shitty fact pattern where they're spread out over 10 states, it is very prohibitive. And these businesses are like Avalara, although they have a great product, that you have to spend 10, 15, 20,000, and it is very prohibitive. I agree. And unfortunately, there's not a lot that can be done about that. What is the connection between sales tax next? I'm going to just go through the questions, Ann, and people are free to jump off as they choose. Ricky Nagano, what is the connection between sales tax nexus and income tax nexus? The short answer is there's no connection. They both have their own set of rules. The real answer is that as the states saw how easy it was to implement the sales tax economic nexus rules, they're applying those same rules to state income tax nexus rules. So for example, more and more states are moving to a single factor apportionment where they're trying to have their income tax nexus be based on just having a sales, a certain amount of sales in the state, right? Saying, and to take it one step further, they're applying the same dollar threshold that they're applying for sales tax purposes. But other than that, it's not necessarily the case that if a company has required to file sales and use tax in a state, they're also required to file state income tax in that state. And it's definitely not the case that if a company has a sales and use tax liability in a state, that in no way is going to mean, and I would say most of the time when a company has sales and use tax liability in a state, they're not going to have state income tax liability in the state. Going back to Carrie again, on my first question, just thinking of the administrative burden of seller tracking certificates. Yeah, the administrative burden isn't that great because most states allow a leeway of an exemption certificate. So outside of Florida, like Florida, on their exemption certificate, it says that the certificate has to be updated on an annual basis. Most states will allow some sort of a leeway where one certificate can be used for, several years. Obviously, you can't have, you can't be doing business with a company for 20 years and just have one from like the 90s in place. But most of the time, and I've dealt with this on many audits, they'll usually allow leeway if you have certificates that are a couple years old. But again, it is a administrative burden, and that's why, going back to the technology tools, that's yet another selling point that Avalara has, because they have, an ECM, an exemption certificate management tool, and there's a lot of other providers that have similar tools. And I think the last question was it. Oh, okay, that's it.
That is it.
Your question. Good?
We are good. Thank you so much.
Thanks a lot, everyone. Take care. Have a great day.